Welcome to the Wealth Wisdom, where money has history and knowledge becomes power.
What if I told you that the most profitable moments in banking history are the exact same moments when the rest of the world is collapsing? It sounds wrong, almost offensive. We grow up believing recessions are disasters, moments everyone fears, avoids, and prays never happen again. But for a certain part of the financial world, recessions are opportunities, not accidents, not misfortunes, opportunities. There exists a century-old banking strategy that survives downturns and actually feeds on them, a strategy that becomes stronger exactly when everyone else becomes weaker. It's been used for over 100 years, through every major crisis, the Panic of 1907, the Great Depression, the recessions of the 1970s, the 2008 financial crash, and even the silent cracks forming right now beneath your feet. And most people have absolutely no idea. Today, you will. Because this strategy shapes your economy, your opportunities, and your future, whether you know it or not. But to understand it, we have to travel back in time, to an era most people barely remember, a time when banking was brutal. In the late 1800s and early 1900s, banking was messy, chaotic, and unpredictable. There were thousands of small banks, many run by families or local businessmen. No deposit insurance, no federal safety nets. A simple rumor was enough to make people line up outside a bank and wipe it out in hours. But hidden inside this chaos was a pattern that powerful bankers were beginning to notice. Every time the economy crashed, something interesting happened. The largest banks suddenly got bigger, not through innovation, not through brilliant business strategies, but because whenever a recession hit, assets crashed in value, and the strong banks with cash could scoop them up for almost nothing. Land, failed banks, companies, entire industries, all available at fire sale prices the moment panic kicked in. Until 1907, this was just an accidental advantage, but that year changed everything. In 1907, a financial panic spread across America like wildfire. Stocks collapsed by half, businesses froze. People rushed to withdraw whatever money they had left. It was total chaos. And the country realized something terrifying. There was no institution powerful enough to stop a complete collapse. Except for one man, J.P. Morgan. He wasn't a government official. He wasn't elected. He was simply the wealthiest, most influential banker alive. And in a moment of crisis, he did something unprecedented. He locked the biggest financiers in New York inside his private library and forced them to coordinate a rescue plan. He ordered who should be saved, who should be allowed to fail, and who should merge with whom. The public saw him as a hero, a savior, the man who prevented a total meltdown. But behind the scenes, Morgan's empire grew massively. By rescuing failing banks, he gained control over their assets, their deposits, and their influence. The crisis made him stronger, not weaker. This was the moment the strategy revealed itself. When panic rises, assets fall. When assets fall, the strong buy the weak, and when the economy recovers, the buyers become kings. The government took the wrong lesson from 1907. Instead of breaking this dynamic, they tried to make rescues easier. In 1913, they created the Federal Reserve. The Fed was supposed to stabilize the system and prevent future panics. But unintentionally, it did something else. It standardized the crisis profit cycle. Banks were now allowed to lend far more money than they actually had, through fractional reserve banking. This increased leverage, and leverage increases vulnerability. Vulnerability ensures future crises, and future crises ensure future consolidation. On top of that, the Fed became the lender of last resort, meaning that during a crisis, it could flood the system with money and decide which banks lived and which banks died. This wasn't advertised as a tool for consolidation, but that's what it became. And nothing proved it more clearly than the Great Depression. In 1929, the market crashed. Businesses failed. Families lost everything. Factories shut down. It was the worst economic collapse in American history. But here's the part most people never hear. Between 1929 and 1933, over half of all banks in the United States disappeared, thousands of them. Some failed, many were absorbed, and the survivors, they emerged far larger and far more powerful than before. While ordinary people struggled to find food, strong banks were buying distressed assets for pennies. Land, mortgages, gold, businesses, future revenue streams. They were building empires on the ruins of the economy. The strategy wasn't a theory anymore. It was now the operating system of modern banking. Fast forward to World War II. After the chaos, world leaders met at Bretton Woods to rebuild global finance. Their goal was stability. What they accidentally created was a global version of the crisis profit strategy. The US dollar became the global reserve currency, and institutions like the IMF and World Bank began lending money to countries in financial trouble. But those rescue loans came with strings attached. Countries were forced to privatize industries, cut public spending, remove protections, and open their economies to foreign ownership. When nations fell into recession, Latin America, Southeast Asia, Eastern Europe, their assets became cheap. Foreign banks bought ports, factories, natural resources, telecom companies, and energy grids. Entire national economies were reshaped in the same pattern that once reshaped U.S. banking. One country's crisis became another institution's profit. Then came 2008, a perfect modern example of the same strategy. Cheap loans inflated a housing bubble. Banks pushed risky mortgages to millions of people. Investors bought them. Wall Street turned them into complex financial weapons. And then it all collapsed. Millions lost their homes. Millions lost their jobs. Companies failed. Panic spread across the world. And what did the strongest banks do? They expanded. They bought failing institutions like Washington Mutual, Bear Stearns, and Merrill Lynch at massive discounts. The government pumped trillions into the financial system. The Federal Reserve slashed interest rates and printed money on a historic scale. By the time the recovery began, the top 5 banks controlled more of the nation's assets than at any point in history. The century-old strategy worked again, flawlessly. But now the strategy is evolving, faster, more aggressively, and more dangerously. Today, 3 forces make the crisis cycle even stronger. Algorithms make markets collapse in seconds. Globalization spreads panic across borders instantly. And record government debt means central banks have fewer tools left to stabilize anything. This means the system is more fragile than ever. Crises aren't rare anymore, they're predictable. In fact, many analysts quietly agree that the next major recession is already forming. Household debt is at record-breaking levels. Corporate debt is exploding. Governments owe more than ever before. Savings rates are near all-time lows. Banks are quietly tightening lending. Defaults on loans are rising fast. These aren't random warning signs. They're the opening scene of a familiar movie. Banks see it coming, and they're preparing for it, just like they did in 1907, 1929, 1973, 2008, and every crisis in between. They're raising capital, selling risky assets, closing branches, quietly acquiring smaller institutions, and waiting, because when the recession hits, and it will, distressed assets will flood the market, weak businesses will fail, small banks will collapse, savings will evaporate, real estate prices will fall, and history will repeat itself. The strong will eat the weak, just like they have for a century. But here's what you need to understand. Recessions don't destroy wealth, they transfer it. Every downturn in history has moved wealth upward, from ordinary people to powerful institutions that know how the cycle works. Panic isn't a side effect, it's a weapon. Your fear is what discounts the value of the assets banks later buy. Your desperation is what fuels their opportunity. Your losses become their gains. Once you see this cycle clearly, everything changes. You stop imagining recessions as unpredictable disasters. You start seeing them as engineered outcomes of a system that profits from instability. And you realize that the only real protection you have is knowledge, understanding the cycle so you don't to become the panic that feeds it. You don't need to be a billionaire or a banker to protect yourself. You just need to stop moving with the crowd. Stop borrowing at high interest, build savings, stay liquid. Study how asset prices behave in downturns. Watch the signs, prepare, instead of react. Because the truth is simple. This strategy isn't illegal. It isn't hidden. It's documented in history, repeated in data, and embedded in the design of modern banking. But most people won't see it until it's too late. The next recession is coming. The cycle is already forming, and the institutions that understand it are already positioning themselves for the next wave of consolidation. The real question is not whether the strategy will repeat. It will. The real question is whether you'll be ready, or whether you'll be one of the millions who only realize what happened after it's over. If this opened your eyes, hit like, subscribe, and share this with someone who still believes recessions are just bad luck. And tell me in the comments, do you think financial crises are natural or designed by the system itself? Your answers will shape the next investigation.